All right, so this is the second video for our March 1st class. And in the previous video, we looked at the different capital budgeting, decision-making tools, NPV, IRR, payback, profitability index, MIRR, and I explained how we would use those to make a decision. In this much shorter video, we're going to be looking at page 8 in the notes and talking about the project cash flows. So your project for next week, and I'll show you the spreadsheet when we get through these notes, but your project for next week, you will be looking at a case and you'll have to make decisions about what cash flows to include or what decisions to include in your capital budgeting project before you evaluate it using NPV and IRR and those things. So I'm going to talk about the cash flows. And you'll need these ideas to make those decisions properly. Okay, so what we're going to do is go through the incremental cash flows, the description of the different things. I'm going to show you the spreadsheet for your next case that will be put out online along with the questions. And then I'll do a third video, and it's going to be just the examples from your textbook and using Excel to calculate the different measures and to show again some examples of how to calculate NPV and IRR and so on. But in this video, we're going to start with project cash flows. We're on page 8 of the notes. It says here the relevant cash flows for a project are the incremental cash flows. So the incremental cash flows for a project evaluation consist of any and all changes in the firm's future cash flows that are direct consequences of taking the project. So the only cash flows that matter for a project are the ones that occur as a result of taking on the project. The only cash flows that matter. The only cash flows that matter are the ones that are a result of taking on the project. All right. So it's also important though to include all of the cash flows that are the result of taking on the project. So you shouldn't ignore some cash flows, and we're gonna come across some of those here that result from taking on the project. So the first item we're going to talk about is sunk costs. Now it says incremental cash flows here. Sunk costs are actually not an incremental cash flow. This is a cash flow. This is usually an expense that is incurred prior to taking on the project and is not a result of taking on the project. So it's an expense incurred prior to taking on the project, not an expense incurred as a result of taking on the project. And oftentimes these sunk costs are incurred in making the decision or gathering information about the project. And so what happens is that people feel like they've already put costs into the project and they need to account for those costs in the decision-making project, but it also kind of ties them to the project and with the idea that they don't want to lose money on the project. They don't want to lose that investment that they've made. Let me give you an example of this. Several years ago, at the beginning of the internet age, the bank I worked for had a customer. His name was Roger Asay, A-S-A-Y, and he had the biggest catalog at least in the United States, probably in the world, of used office equipment. And not little tiny things, like little calculators or something, but big pieces of office equipment like large high volume copiers, very large printers, things like that. Things that cost thousands of dollars. And what would happen is, if you wanted to sell your big piece of office equipment, you would often contact him, send him a picture of it, send him the information for it, and he'd put it in his used office equipment catalog. Okay. And that's how he made money. And he actually did pretty well. He would put together this catalog and he would send it out, and you would pay him in order to have your office equipment listed in his catalog. Well, at the beginning of the internet age, this would have been the year 1999 or so, he started thinking that he might want to put his catalog online. And so he hired a consulting firm to come in and calculate how much it would cost him to take on this project and whether or not he would likely be able to make money. So he hired this consulting firm, and I can't remember how much they cost. It was a substantial amount. And they gave him a report back saying, this is likely your cash flows from the project, all the things we'd look for in a capital budgeting project. These are the things you need to invest in. These are the people you need to hire to run things. And in the end, he looked at the report. It did say, yeah, we think it would be a good decision to go ahead and put your catalog online. And he used that. He used the report and made the decision to go online. Now, the hiring of those consultants is a sunk cost. It's a sunk cost because they could have given him a report back that said, this is a bad idea, you shouldn't do it. Well, he's already out the money. Okay, so he's out the money whether or not he takes on the project, because that was a sunk cost. It's something that happened before the decision to take on the project. So taking on the project didn't affect that cost. So that's a sunk cost, and we don't want to include it. It's not an incremental cash flow. The opportunity cost. So the opportunity cost, what else could we be doing with the money or with the assets that we aren't able to do as a result of taking on this project? So what opportunities are we giving up? What could we be doing? So if we're going to use a building for a project, well, what else could we be doing with that building? And we want to take that into consideration whenever we examine a project. We may not be able to directly come up with a number for that, but it's something we want to keep in mind whenever we look at a project. So that's also something to consider there. We also want to take into account side effects. And in some economics courses, you're going to hear the term externalities. I like that term. These are things outside of what we really consider to be the project that may come as a result. A common externality is a quantitative one. It's referred to as erosion, or you may have heard it as cannibalism. Not in the literal sense of people eating people, but in the sense of, if we take on a project, it's going to affect other products or other services that we provide. And so we're going to have to take into account a loss in sales and a loss of cash flows on other projects as a result of taking on a project. So, for example, if Toyota comes out with a new model, or with a new car, we need to account for the loss in sales of other models. And that is a specific number that we want to take out of our cash flows when we project our cash flows out for a project. So quantitative side effects are dollar amount, and when we can calculate those, and we should take those out of our project cash flows. So these should be accounted for in project cash flows. Okay, and that says cash flows down there. Qualitative ones, it's not something we can really account for in the financial models, but I always encourage people to take a look at the qualitative side effects that can occur as a result of taking on a project. And when I talk about these, I'm usually talking about things that will affect your employees, things that will affect your customers, things that will affect your community and society in general. And we need to take into account how our projects, the projects that we take on, can harm or benefit a society and a community that we serve or we live in. The example I give for this one, many years ago, there was a place called the Old Swimming Hole. It's spelled something like this. And I was a credit analyst for a bank, and this has been about 19 years ago. I was a credit analyst for the bank that made the loan for the Old Swimming Hole down near Joplin, Missouri. And you can look it up online. There's a guy who's gone through it now. You can see it's no longer open, and there's a good reason for that. So the gentleman who started the Old Swimming Hole came to our bank. We knew him because he did the landscaping for our bank, and we had 8 locations, and so he did all the landscaping for us. And he did a good job, but he had this idea that he wanted to start a water park. The reason he wanted to start a water park was because the community there, Joplin, Missouri, had that year put on the ballot bonds for financing for a city-owned swimming park, for water park for the community there. And it was voted down. It was rejected. But he said, you know what, I think there's demand there and I want to start one up. So the guy was really good at landscaping, but not terribly bright in other areas. He came into the bank with a 10 by 14 inch sheet of paper with the water park drawn out in crayons. And I wish I was kidding about that, but I'm not. And so he asked us for $500,000 in order to pay for his water park. And we kind of laughed, not at him, but privately, and said there's no way we would ever do this loan. Not a chance. It's just too risky for a bank to engage in that kind of loan. But then he said, oh, wait a minute. My wife just inherited $1 million in stock, and at the time, the company was doing much better than it did a few years later, but $1 million in stock in Bank of America. Well, that changed our minds a little bit because he said, you can take this as collateral. So we're making a $500,000 loan, $500,000 loan, and we get to take as collateral $1 million in Bank of America stock. And what that means is that we signed an agreement with his stockbroker saying that all we had to do was show that he didn't make his payment on time, and we could go in and take out our $500,000 plus any interest, plus any penalties, any costs that we had associated with the loan, and get those back just by selling the stock. The broker would sell the stock for us. So in terms of risk, there was almost none. The only risk would be if the stock cratered and dropped by more than 50% in value. So we took on very little risk, almost a guaranteed return. And in the end, I was not at the bank when this situation ended. I'm sure that they got their money back. The bank got their money back. But here's the problem. As I was walking through with the loan officer and him through the project as he was building it, and it was impressive. And again, you can go out online and you can see a video of this place. He had water slides. He traveled over the U.S. Picked up used water slides. He had poured thousands of tons of cement to build water slides and pools and everything else. But as we're walking through, I asked him a question, and I said, have you had an insurer who specializes in water parks look at your water park, look at your plans to make sure that it's insurable? And he said, no, I talked to and I have no problem with this company. I use this company. But he said, I've talked to my State Farm insurance agent, and they said it's fine. Okay. So that should have sent up a red flag. But again, we had $1 million in Bank of America stock securing our loan, so not really a risk to us. So here's what happened. On the day that there were some complications, some problems. He eventually did have to have an engineer come out because the water system he put in was not big enough. It wasn't good enough to make the water flow appropriately, so he had to change that out. But other than that there wasn't really many hang-ups with getting the water park started. But eventually what did happen is the day before he opened, he kind of had a test run. He brought a bunch of little kids out to try it out. They started running into the pool. So it was a zero depth entry, if you know what that means. In other words, you could just walk into the pool. There was no dip down, there was no climbing a ladder or anything like that. And so all these kids are really excited, they're running out to the pool. Well, it was painted cement, and they hit that wet painted cement and they just slid. They fell on their butts and slid. So he had to, drain some of the water out of the pool, get out there. His guys had to get out there with sandblasters and make it a little rough, and then repaint it and fill it back up with water. And that was fine then. As the years went on, there were a few accidents at the pool. And then a few years later, a boy by the name of Ethan Corey died at the pool. He was, I believe, 6 years old. He had drowned underneath one of the water slides, and the pool, basically what they determined was that there weren't enough trained lifeguards at the pool to oversee things. So he lost to the swimming hole, and as a result, the state of Missouri passed Ethan's Law that required that every private swimming pool that was charged, that was a business, charged people to come in, had to have a minimum of $1 million in liability insurance. $1 million in liability insurance. And the idea was that, and for the same reason I was asking about it, the idea was that an insurance agent is going to come in and they're going to look over the plans, they're going to look over the pool, they're going to keep up on the situation to make sure that all of the that all of the safeguards are in place to protect people coming into the pool. The old swimming pool was found liable because they did not have properly trained lifeguards, and they didn't have enough lifeguards for the size of the pool that they had. However, they also didn't have any liability insurance, so there was a very large fight as a result of that between the child's family and the swimming hole park, which was eventually shut down. So keep that in mind when you think about the type of projects you want to invest in your community. In the state of Kansas, there is an agribusiness law, which is kind of similar to this situation, that says that no agribusiness, tourism business based on agriculture, is required to have liability insurance. And if you go to one of the, some of the local places that have corn mazes or hay rack rides or something like that, they'll actually have signs up saying that they're not required by law to have liability insurance, and they don't have liability insurance. So that's something to keep in mind when you think about, again, think about the projects, how they will affect the community that you live in. And another thing we need to take into account is net working capital. So this is an increase in accounts receivable, and inventory that occur as a result of taking on a project. So if we're going to start it, we're going to have a new project with a new product or new service, it's probably going to result in increased accounts receivable and increased inventory. We're going to have to come up with cash to pay for those things as the project moves on. On the next page, on page 9, we have financing cost. And so for financing costs, that's the interest expense the company is going to pay on its debt. We do not want to include this in our project cash flows. Do not include in project cash flows. The reason we don't want to include the interest expense, there's two reasons. First of all, the choice on how to pay for the project, how we're going to come up with the cash to pay for the project, either equity or debt, is made separately from the decision on whether or not to invest in the project. So it's a different decision. So we could lower the increase the cash flows of a project by choosing to invest entirely with equity. But that may not be the best decision for the firm, and that's something we're going to talk about later on in class. So we don't want to include it for that reason. It's a different decision. It's not an operating decision. It's a financing decision. The second reason, so I'm going to put that down. One reason why not to include, it's a financing. It's the result of a financing decision. Secondly, it's actually included in the weighted average cost of capital. So the cost of debt, or the required rate of return on debt, is included in the weighted average cost of capital. It's one of those two costs. We have the cost of debt, we have the cost of equity, we can also have a cost of preferred equity. So it's already included, it's part of the discount rate. So if we took it out and then used it as part of the discount rate, we're kind of double counting it against the project. So we don't want to do that. Okay, so leave out the interest expense, don't include it in your calculations. The last item here is cash versus accrual accounting. And I talked a little bit about this when we went through our project with the lemonade stand. I told you that was accrual accounting. So for a capital budgeting project, we care about cash. Okay, so we take everything, what we do is we take everything back to cash. We start with the revenues for the project. We account for any accounts receivable and inventory we have to invest in. And really this is where it matters, a difference between looking at financial statements and looking at project cash flows. It matters in two different areas. The first is depreciation expense. Companies will sometimes use different depreciation methods between their annual reports that are given to the stockholders and what they tell the IRS. And so we want to use the depreciation method that is used for tax purposes. So one thing I like to tell people is that I always like to, if I'm evaluating a company, if I can, I like to look at their income tax statements. Now, you can't really do this for large publicly traded firms. They don't release those. They release their annual reports. But if you can, it's nice to look at tax statements because people have a tendency not to over-report their income for tax purposes. Okay? And I think about that for a second. If they over-report their income, they're paying too many taxes. And they want to really, their goal is to reduce their taxes as much as, to the lowest amount possible, and that means reducing their taxable income to the lowest amount possible. And so when we care about cash flows, that's what's happening. They want to reduce their tax to the lowest amount possible. So they're going to use usually some kind of accelerated depreciation method to depreciate their assets. Now, it doesn't really hurt their project cash flows because we actually add back the depreciation expense. So we take it out, and I'll show you this on the Excel model that you're going to use for next week. But they take it out, they calculate their taxable income, then they add it back in because it's a non-cash expense. So that's the first place that it matters, is depreciation expense, the method used. We want to use the method that's used for tax purposes. If they're using a different method for their annual reports, it's probably one that shows a higher income, lower depreciation expense, and higher income than the one used for tax purposes. So that's the first place. The second place is that when we look at having an asset that we sell off at the end of the project. So let's say we buy a big piece of equipment, and at the end of the project, we can sell that off. So we're not using accrual accounting, and this is just kind of a nitpicky thing, but I've had accountants bring this up to me before, and we're not looking at the end of the project, we're not looking at the book value of the asset to determine its taxes on the gain on the sale of the asset, and if that doesn't make a lot of sense, it's okay. We're actually looking at the basis value. So I'm going to put on here basis versus book value. So if you think of a balance sheet and the fixed assets portion of a balance sheet, we have gross fixed assets, gross fixed assets minus accumulated depreciation and then we have net fixed assets at the end. Oops, sorry about that. That's an F, fixed assets. So that is the word fixed, not fired or anything else, but fixed assets. There we go. I'll just put a little better there. Net fixed assets. Gross fixed assets minus accumulated depreciation equal our net fixed assets. So we would refer to this as the book value. For tax purposes, though, we don't use the term book value, we use the term basis value. And it's calculated the same way, except for our depreciation is not the one used for the annual reports, but the one used for tax purposes. So when we look at taxes and tax statements, we use the term basis value. It's not terribly important at the end, but if you do see that, I want you to understand the difference. That this is what's used for tax purposes, and it's really what we're looking at for a project and its cash flows, rather than the book value, which is what we would see in the annual reports. So let me turn now to, if you go out on D2L, I put out the Excel documents for or workbook for your project, and it looks like this. I want to show you a few things on this. So what I'm asking for you to do for your project for next week is I want you to look at a set of policy decisions you're going to need to make for this project that come up in the case, and all of those decisions are made up here. Okay. So you see all this down here. There's a lot of information here. I don't want you to touch any of this. Okay? If you do, you probably will get the wrong answer. All of these numbers can be changed up here. So what I want you to do is read through the case. Probably should start off by reading through the questions you need to answer first. And as you come up to them in the case, you'll need to make decisions. It's really important here that you think about whether or not the cash flow or the expense or the revenue or the additional investment outlay, because there are situations in the case where you might have that, is the result of taking on the decision. Is it an incremental cost or an incremental cash flow of taking on the decision? So let me go through this a little bit. We're looking at the output in pounds that the company, let's see, is currently making. Okay, so that's the annual output. You see down here an estimate of the incremental gross profit. So that's important. This project is adding on additional capacity for an existing product that the company sells. The output gain divided by the original output. So it's saying the gain is going to be 7%. So currently their output is 250,000 tons per year. This project will allow them to increase their output by 7%. And down here below, we see that is 267,500 for the life of the project. During the first year of the project, so you see now here, and it's not really clear, but this is now. And there is a number there, and I'll get to that here in a minute. But at time 0, so this is, this is year 0. Okay, so I'll actually put a 0 up here to point that out. Year 1, we're going to have some construction going on, so we're going to lose some output. But these are the incremental sales, new gross margin, new gross profit. The old output, the old sales, the old profit, and this is the estimated incremental cash flow from gross profits for each year of the project. WIP inventory is work in progress or work in process inventory. Again, as we increase our output, the amount of inventory we need to have is also going to increase. So that's a cash flow, an increase, a use of cash, if you will, for the project. And here we have additional new depreciation expense that we wouldn't have had before. Finally, we have new overhead, and you're going to have to think about this one. This is going to be one of the questions on the assignment, is whether or not or how to account for that additional overhead that the firm has. Possibly is taking on the project. The preliminary engineering cost, again, it's a cash flow that shows up on here. You're going to see it's also up here. So preliminary engineering cost. This is the amount right now, and again, you can change that up here. So 12 million is our initial outlay. That's our time 0 cash flow. So the idea is that we're going to invest $12 million today to increase the capacity of our project, or I'm sorry, of our plant. And then in the end, you can see here, we have our pre-tax incremental profit. So again, these are the incremental cash flows from taking on the project. We add back the depreciation expense, and then we're going to subtract out the increase in the work in process or work in progress inventory to get our free cash flow or our project cash flows for the firm. So, and I'm going to show you an example of how to work this in the next video. But from that, what I want you to calculate is the NPV, the IRR, the MIRR, the profitability index, and the payback period. And I'd like you to use the Excel functions that I'm going to demonstrate in the next video to do that. Okay. So for the project, you'll need to make a set of policy decisions And in doing that, you'll change the numbers in this in these assumptions up here in this box. Don't mess with these. These will all change as a result of what you put in the box. And then you'll need to calculate the NPV, IRR, MIRR, profitability index, and the payback period as a result of that. Okay, please let me know if you have any questions. I apologize for missing class. On Wednesday night, it was something that was really unforeseeable for us. So there's going to be one more video. It's going to go over how to use Excel to calculate all these things.